We made a deal with China. We made a deal. We're close to making a deal with India. Others we met with, and we don't think we're going to be able to make a deal. So we just send them a letter. If you want to play ball, you have to. This is what you have to pay.
President Trump threatening higher tariffs on several trading partners, but suggesting he's still open to additional negotiations after delaying those hikes until at least August 1st. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the president's trade policy with crucial context and sharp analysis. The president's threats include 25% levies on Japan and South Korea, but investors seem unfazed, sending stocks in those markets edging higher. The euro gains on a report the U.S. is offering a 10% tariff deal to the EU. We'll dig into the latest developments with a former U.S. Assistant Trade Representative. Hear why Claire Reid thinks Trump seems to relish the theatrics of his policy approach. Plus, with Malaysia also in the firing line of a potential 25% tariff rate, we'll focus on its key role in the semiconductor supply chain with the Institute for Democracy and Economic Affairs. President Trump has sown further confusion over his tariff plans. He now says he'll be flexible on a new August 1st deadline, just hours after signing off on it, effectively giving countries another 3 weeks to cut a deal.
I would say firm, but not 100% firm. If they call up and they say, would like to do something a different way, we're going to be open to that. But essentially, that's the way it is right now.
The president earlier sent letters to trading partners threatening higher tariffs, including 25% rates on Japan, South Korea and Malaysia. Meanwhile, the U.S. is said to be closing in on deals with the likes of India and the European Union. Let's cut through all the noise and bring in Bloomberg's chief North Asia correspondent, Stephen Angle in Hong Kong. Also joining us is our Southeast Asia economy reporter, Claire Chow in Jakarta. Steve, let's start with you. Japan, South Korea, among the first at the negotiating table, but still now facing 25% tariffs.
Yeah, it's interesting to try and read what Donald Trump is actually saying and the message he's putting out there. Sure, there's a reprieve again for about 3 weeks, but really hitting hard Japan and South Korea. I guess because he's perceived that those nations, as Scott Bessent earlier this week has said, they might be dragging their feet on negotiations, even though the Japanese and the South Koreans have been working quite tirelessly to get movement on some sort of deal to mitigate the not only reciprocal tariffs, which are now put in place at 25% as of August 1st for both countries, but also if you take into consideration the 50% tariffs, sectoral tariffs on steel and aluminum and 25% on automobiles. It's quite a stiff penalty for Japan and South Korea to do business and trade with the United States. But again, it's some mixed signals here because, and Claire will talk about these Southeast Asian nations who have been working in earnest just as well to get a deal, only to see their tariffs essentially reaffirmed. I'm talking Thailand. I'm talking Indonesia. Claire will break those down in just a second. But right now, we're hearing in Tokyo and in Seoul officials talking about regret and things of that tone. Ishiba, the Prime Minister of Japan, saying the move by the Trump administration overnight was regrettable, but they do have time, and the markets have not had the knee-jerk negative reaction like we saw in early April because there is more time. Granted, there are local politics at play in South Korea and in Japan. There's an upper house election coming up at the end of Japan, and Ishiba's party is on tenuous footing, obviously. Also, we have a new president in South Korea, so he doesn't want to make too many concessions. Maybe this buys them time to come up with a lasting deal with the United States, or maybe it is really Donald Trump laying down the law and saying, if you want to play ball, you got to meet our demands.
Well, that's right, 25% for close allies, Japan and South Korea. Now, when it comes to Southeast Asian nations, Claire, they were hit hard too. Anything between 25 and 40%, that's really tough.
I think Southeast Asia is one of the hardest hit regions in the world, and it's really targeting the world's manufacturing floor. Well, the message from ministers so far across the region is that tariff talks are ongoing and they will try to secure a lower rate before this August 1 deadline. Notably, though, their optimism is much more measured, much more muted now compared to a few days ago when they thought they were very, very close to clinching a deal, and they even thought they could get a rate at the best case 10% or even lower. There's some sense of frustration as well. Thai Finance Minister Pichai had said that he was shocked that it seemed like their latest proposals hadn't even been taken into consideration in this round of letters that Trump had sent out. And it's really hard to see where else Southeast Asian nations can go from here. Indonesia had already offered a near zero tariff rate on 70% of U.S. imports, Thailand close to 90%. And these nations, as much as they do want to appease the U.S., also want a win-win solution for their countries, as their economies have already not been in great shape before this trade war. And now the first on the line will be Malaysia. It's going into a rate decision this afternoon, and much of the attention will be on how they can soften the blow on their economy with that 25% tariff rate. Yesterday, economies were still a bit split, some seeing a hold, but it could very well be their first rate cut since 2023.
Claire Chiao, Stephen Angle, we thank you so much for your perspective there. Let's get more on the tariff implications with our next guest, who previously served as the Assistant U.S. Trade Representative for China Affairs and Chief Counsel for China Trade Enforcement. Joining us from Washington is Claire Reid, Senior Counsel at multinational law firm Arnold & Porter. Claire, good to have you with us. I mean, we know that the deadline has been extended to August 1st. It does feel like he is kicking the can down the road, prolonging the uncertainty. You get a sense that perhaps, it is all intentional. How are you reading the moves from the president?
Well, I have the sense that President Trump is operating really on the political level and at a very sort of 100,000-foot level in terms of these negotiations, so that he is trying to project strength and a resolute attitude about what he perceives as these other countries screwing the United States, to use a technical term. And at the same time, I think he probably was not really aware of how much time it takes to negotiate an agreement like this. So I'm not surprised that there has been an extension. And I'm not surprised that he is expressing a little bit of flexibility in terms of even that August 1 deadline now.
Do you get a feeling that the letters he sent are actually warnings, giving the likes of South Korea and Japan an opportunity to perhaps make those concessions they weren't willing to make before?
Well, I would say he's trying to incentivize all of the trading partners to come in and give their best deal. I do think there have been some constraints on both South Korea and Japan in the earlier parts of the negotiations because of their domestic political situation. So I think this extension is valuable for both countries. The question as to whether 3 weeks is going to make the difference is an open one, but it's certainly better than having the sword of Damocles fall on July 8th.
The thing is, the trade negotiation has been pretty erratic, in fact, unpredictable. You can't help but feel that the whole process would erode the confidence that, trading partners have in the U.S. and hence would drive them to perhaps look at alternatives in a much serious way.
I have to agree with you. I mean, the United States is a large player in the global system. So many or most of these countries are going to want to come up with some kind of a compromise that calms the current boiling waters so that they are not, just destroyed by the Trump approach. But at the same time, I have no doubt that U.S. trading partners are trying hard to think about what other alternatives they have that would shield them from all of these uncertainties and stresses.
The key question, Claire, is how long the uncertainty will remain. And you got to wonder as well whether in that time, trading partners, some of them might just retaliate. And if they do, what form might that take?
That's a delicate question, because to the extent that the trading partners are smaller economies than the United States, it could be very damaging to them to retaliate. Trump has already stated that if a country retaliates in the form of tariffs, that Trump will put the exact same value of tariff on top of whatever the tariffs are that he has said he wants to charge the country. So it's dangerous. But I do think that over the longer term, you're going to have a desire to defend against this uncertainty and this volatility. And countries are going to take a variety of actions to do that, whether it's creating closer trading relationships or trying to prioritize other partners. And the larger trading partners could well be considering outright retaliation to the extent that they view that as cost effective.
Let's bring in the BRICS nation. We know that Trump has threatened additional 10% tariffs if they're seen as adopting anti-American policies. Are they showing any anti-American sentiment? I mean, how do you define anti-American policies? Do you see the BRICS nations doing that?
Well, unfortunately, the arbiter of whether there are anti-American policies is going to be Donald Trump. And he has a fairly spontaneous and sometimes impulsive way of making those decisions. I know that the discussion of trying to replace the dollar has been something that really caught his attention and is very bothersome to him, and he's already made a specific threat about that earlier this year. But it's not clear to me that there's anything the BRICS are doing right now that could be considered anti-American. But again, it's in the eye of the beholder, and unfortunately for all of us, the beholder is Trump.
Pretty perplexing there, we know, because it's hard to define. Does it then come down as well to the fact that Trump dislikes multilateral arrangements, whether it's BRICS, whether it's WHO, whether it's WTO? He doesn't like multilateral arrangements. He prefers bilateral arrangements. Is that the crux of the matter?
Well, I think you make a very good point. The reason I don't think he likes the multilateral setting is that he has less control. So he wants to do one-on-ones where he feels like he understands the leverage he has and can apply it very directly. Whereas the multilateral setting sets him up potentially for less control and less understanding of what the dynamics are.
Claire, as Japan, South Korea await their fate when it comes to those tariffs, China has a different deadline. It's 12th of August. How are you looking at negotiations within the U.S. and China? Is Trump giving China a bit more slack than before?
Well, it's interesting when you consider how China has responded to Trump's pressure. China has said, we are not going to bow to Trump. China put in place retaliatory measures. China did not back down when Trump escalated. China just matched what the United States did. And I think the United States realized, unlike what Secretary Bessent said at the outset of the negotiations with China, that if we're looking at it as a poker game, in fact, China holds cards that are much better than just a pair of deuces. So there is, I think, more of an understanding of what's at stake, that where the United States cannot simply come in and dominate the discussion. Now, the open question is, where are there places in the U.S.-China relationship where you can actually come up with a deal that both sides are willing to agree with? I think that's very tough. And I don't know where they're going to find that common ground or whether they will. But I think for both sides, there isn't really a desire to have a gigantic bonfire of trade spat going forward. So they will probably try to find space where they can.
Do you get a sense, Claire, that perhaps China has the upper hand in these trade negotiations between the U.S. and China, given the dominance in critical minerals?
Well, certainly the critical minerals have demonstrated that China has leverage. I also think the currency situation with China creates leverage for China. And not just holding of the treasury bonds, but what the impacts are on markets of China's shifts in the value of the yuan. So there are a number of factors that I think have to be taken into account by the United States in dealing with China, and China is much larger. So it's not a David and Goliath situation. It's two Goliaths, and that just changes the negotiating dynamics.
Claire, we appreciate your perspective there. Claire Reid, Senior Counsel at Arnold & Porter. Now, still ahead on Insight, U.S. Secretary of State Marco Rubio is heading to Malaysia this week as tariff tensions dominate. We'll take a deep dive next into what's at stake for the country's aims to become a regional chip-making hub. Keep it here with us. This is Bloomberg. You're watching Insight. U.S. Secretary of State Marco Rubio is heading to Malaysia after President Trump threatened to slap a 25% tariff on the country's exports to the U.S. Rubio will be in Kuala Lumpur for an ASEAN leaders meeting as the bloc's other members, such as Laos and Myanmar, face threats of even higher levies. Meanwhile, Bloomberg also reported recently that Washington plans to restrict shipments of AI semiconductors from companies like NVIDIA to Malaysia and Thailand to prevent suspected chip smuggling into China. While Malaysia plays a significant role in the global semiconductor industry, particularly in the back-end processes of assembly, testing and packaging. Let's get insights from Sharmila Suntherasegarun, Assistant Research Manager at the Institute for Democracy and Economic Affairs, a Malaysian public policy think tank. Good to have you with us. What's your take on those 25% tariffs being slapped on Malaysia? It seems still very high.
Yeah, I mean, the pause did bring some time, but it didn't bring any clarity. Unfortunately, we are still back in the zone of uncertainty. 25%, it is high, but it is not as much different from the original announcement. And given that there isn't any clear framework or criteria on how these rates are set, it's really difficult for countries like Malaysia to prepare for it. And I also think the real risk here is also not the tariff itself, but it's also the unpredictability. I think we've all seen how quickly rules change under Trump, and it makes it really hard to plan or invest, especially for long cycle industries like semiconductor or AI. I think businesses can handle the cost, but I think what's harder is making decisions when goalposts keep moving. I think that is the issue that currently countries in Southeast Asia and around the world are facing.
As you said, 25% is not much higher than what was initially slapped on Malaysia, not much lower either. I'm just wondering what impact that might have on the Malaysian economy.
I mean, naturally, tariffs do push up costs and uncertainty does slow investments. I think in the US, especially the Fed considering rate cuts, I think higher tariff does complicate risk when it comes to raising inflation. And when the US economy slows down, I think the rest of the world feels it. Direct impact, I think, will not be as much as anticipated. I think given how businesses will be already adapting to supply chains and tariff enforcements can be quite tricky. But I think what's important is to consider the indirect impact on investments. It's something that government should be monitoring, like in Malaysia. Given all the uncertainties, businesses worldwide will be holding back on their investments. And there's also a lot of risk in terms of financial volatilities, financial market volatilities. So I think these are the kinds of indirect impact that countries like Malaysia should be looking into. And also, I think another angle to look at is not only in terms of economic costs. I think unpredictability of the US policies also causes and threatens reforms in the region, especially in terms of transparency and also in terms of creating more room for rent seeking and also for regulatory backsliding.
Sharmila, shed some light on the concerns expressed by the Trump administration, and that has to do with Malaysian chip exports to China. Is that happening? To what extent is that happening? Can the U.S. justify the move and the concerns it's expressing right now?
I mean, it's clear that Southeast Asia is sort of caught in the crossfire between China and the US. The US said it's trying to stop diversions to China, but I think countries like Malaysia and Thailand are paying the price for it, despite the fact that there's no concrete evidence of any wrongdoing. For Malaysia, for example, we don't produce advanced chips. We mostly assemble, test, and package, like you mentioned earlier. And I think NVIDIA has also said that there's no evidence of diversion going through Southeast Asia. So without these kinds of evidence, the restriction itself, I think, feels a bit more of a preemptive overreact to elicit a deal rather than a targeted enforcement. And I think with blanket restrictions like this, penalizing more compliant players like Malaysia who do follow export and trade rules, I think it's a troubling precedent to set. And it's also going to undermine sort of rules-based cooperation that we have and discourage investments in more secure supply chains.
How do you see Malaysia responding? How do you see chip companies in Malaysia responding to what Trump intends to do?
Yeah, I think countries like Malaysia, being a smaller economy, retaliating is not really an option. I think they do have to straddle a bit of a more balanced approach in trying to negotiate and also trying to reassure that the rules that US is concerned about is being followed. But I think it is definitely a concern in terms of AI and semiconductors, which is an industry that requires a lot of confidence and high-scale investment, long-term investment. I think when you're building billion-dollar data centers, you're not sure which chips you're going to be allowed to use for 6 months from now. That's going to be a lot of uncertainty. And given that Malaysia is also looking to move up in terms of the value chain from back-end assembly to things like IC design and also the investments with data center, I think this requires a lot of long-term certainty. And these kinds of unpredictability definitely have to hamper. Yeah.
We know U.S. companies, chip companies, the likes of Intel, Infineon, and NVIDIA have all invested lots of money, billions of dollars in Malaysia for their respective operations. They will get hit too, no?
Yeah, definitely. If these kinds of chips are being used in their operation, or if it's part of their supply chain, it's definitely going to be a hit. But I think bigger companies do have their ways of negotiating things, especially companies that have headquarters in the US. I think we saw a long line of companies striking up deals with Trump once he announces something. So I think companies like Intel and all will be able to figure out a way of navigating this. I think the more important question will be how Malaysia as a country signals that they are also open for making sure that these rules are enforced and following the rules that the US puts out. Yeah.
Sharmila, thank you so much for that. Sharmila Suntherasegarun of the Institute for Democracy and Economic Affairs. Still to come, MNG Investments' Fabiana Fedeli will be joining us to discuss how investors should tackle President Trump's latest tariff threats. Keep it here with us. This is Bloomberg.
Nobody really has gotten a good deal from the Trump administration.
As negotiators continue to finalize these reciprocal agreements, that they might actually build out a little bit of nuance amongst the tariff rates.
There's a real impact of these tariffs on consumer spending in the US, on inflation, on trade flows. Once the front loading kind of disappears, then we're going to get payback.
A lot of our companies rely heavily on Chinese materials, as do domestic producers here in the US. So it's a global supply chain for manufacturing.
Perhaps by focusing on some issues like supply chain resilience, trade liberalization, trade facilitation, in a way in which begins to speak about, a coalition of countries that still want rules-based trade and that could actually offer that safe harbor when the U.S. is turning more protectionist.
Some of our guests sharing their insights on President Trump's latest trade tirades. Now, Asia stocks benchmark is swinging in a narrow range today after President Trump threatened higher tariff rates for several trading partners. Despite fueling further uncertainty, some investors are also seeing the move as a tactic to accelerate negotiations rather than a final decision. Let's get more with Bloomberg M Live strategist Mark Cranfield. Also with us, Fabiana Fedeli, Equities, Multi-Asset and Sustainability CIO at M&G Investments. Mark, let's kick it off. Trump tariffs, just noise, right?
They are. I think the general relief, is partly because the absolute numbers being thrown around now are much smaller than some of the numbers which were talked about earlier in the year. So if you go back into the first quarter, there's even threats that China would receive tariffs above 100%. Even last week, Trump was talking about topside tariffs for some people at 70%. Well, we've seen the first batch of letters, and the numbers so far are quite a bit smaller, that's certainly a relief. Also, the fact that, again, we seem to have pushed the deadline a little bit further. Investors are happy to see there's more time to talk about things as well. So overall, people are not, let's say, comfortable, but at least they're seeing that we might be getting closer to a situation where we can live with some of these things. They may even have more time to negotiate. And in the background, economies are still turning over, companies are still making money. So it's certainly not the end of the world scenario, which it was starting to look like in Liberation Day in April.
But Fabiana, not end of the world, but 25-40% tariffs are really high tariffs, something that they have to live with, and there will be implications on the economy. Yet here we are. Risk appetite seems to be back.
It's interesting, Haslinda. Markets seem to have this level of crisis fatigue. We've learned that we can have big risk events and actually nothing really happens in the end. And so investors continue to invest. And you see how markets are behaving today after those letters have come out. And clearly at some point, something will happen for which that cry wolf will actually be a real cry wolf. But for now, markets are really taking it in stride.
Some say the impact will be seen in July's data. In fact, Powell said that.
Possibly, but some had also said it was going to be seen early on. And the truth is, we still don't know what the final tariffs are, right? Because if this deadline gets extended to the 1st of August, it might get extended further, or, negotiations could happen and some of these tariffs get changed. Some kind of impact on prices needs to be there. It seems logical. But when it's going to manifest and by how much, that's still uncertain.
And what is uncertain is also how you price risk, Mark. You don't even know how big the risks are right now, yet markets seem to be comfortable with pricing in those risks.
There's a lot of unknowns, but investors, there's a couple of things that we can say, okay, these are we're more certain about. Now, the United States has just passed this big tax and spending bill. A lot of people are assuming it is going to increase the US deficit by quite a bit, that there are gaps in the numbers here which don't add up. So investors can start to say, okay, over the next couple of years, there's going to be continued pressure on the long end of the Treasury curve. Curve steepening, which is something we've seen on and off this year, is probably not going to go away. It's something we're probably going to have to factor in for quite a while. That plays into equity markets, into commodities, into other parts of the world. So at least there's an angle to it that investors can say, okay, I can't really move away from this. The short end of the curve is much more volatile, partly depends on the Fed, how the Treasury fund as well. But that's something which we can build around. And you're starting to see it play out in G10 countries. It will probably affect Asia to some extent as well. In fact, I'm interested to hear if is it something which you are putting into your calculations to say we're going to be stuck with steep curves for some time, or do you see that getting flatter at some point?
it will depend what happens also with the supply of paper, although it appears that we're going to have a lot of it, but at what level of duration are we going to have it? But clearly there is some kind of rethinking about U.S. Treasuries. We see it with our own clients. I mean, there is a push to diversify away from U.S. assets. And, this is not necessarily meaning that the U.S. is not going to be investable anymore, but there were such starting point large positions in the U.S. Many were caught so overweight that I think now the thought of diversifying sounds very good.
How does that look like, that diversification? What kind of rotations are we looking at?
So we have actually seen an evolution of this amongst our clients. The first port has been Europe. Europe has some catalysts. That is the higher defense spending, the infrastructure package from Germany, which comes out of a very clean balance sheet, and also lower interest rates. So there are a number of catalysts. Europe was also not expensive, and clients started looking at Europe first. But we also see more clients interested in Asia, and then more recently also interested in broad EM markets.
And the argument for Asia, Mark, it is growth. Some say Asia, emerging Asia, in fact, could outperform developed markets this year.
I think partly because if you look back, particularly to last year, there was a sense at one time that America was the only story. There was no alternative. Everybody had to be in the dollar, they had to be in the US equities and treasuries. Clearly, as we've just been discussing, things are starting to change. Money is moving away from the United States and it's looking for other homes. And it will particularly go to places where there's a potential for a catch-up. And Asian currencies, on a relative basis, they still don't look very expensive compared to the rest of the world. So you have, for a foreign investor especially, you have a double whammy here, a chance of some currency upside plus some equity upside as well. And that is something which people will certainly find attractive. You might be starting to think that there are some laggards here that any particular ones that stand out to you in Asia?
And I do wonder your thoughts on China as well.
Well, we actually have always been invested in China. We do like China. We think it's a market where there is a lot of opportunity. We find a lot of really strong idiosyncratic stories. There is an increase also in terms of return to shareholders. So that has been a market that we have liked and we continue to like. A market where we have added to recently has been India, also because some of the companies in India have a large part of their revenues that are mostly driven by domestic demand and so more insulated by tariffs. We like Korea. There's a lot to be said. There are new discussions about cutting taxes. There's the value up. There has just been the approval of the new Commercial Act, which gives more power to minority shareholders. And we also find interesting opportunities in Southeast Asia, such as Indonesia. So there is a lot. It's only that you have to really do your homework. It's very idiosyncratic. And obviously, you need to be aware of those companies that will have to change the supply chains or their demand outlets because of tariffs.
What's the biggest risk for investing in the countries in this part of the world? We always kick off the year thinking EMs will outperform and EMs always disappoint at the end of the year. What's the risk to those projections?
Interesting enough, EM have actually outperformed the S&P 500 in the second quarter. So we have had one instance of outperformance. I actually think that the biggest risk comes from the U.S. because if the U.S. enters a recession, if actually these tariffs don't come off the table, if there is a decline in confidence in the U.S., if there is a decline in demand brought by this decline in confidence, then that will mean that all countries will be affected by decline of U.S. demand.
And of course, we have Trump administration persisting in its pursuit of lower rates. I'm just wondering how the Fed is looking at it now amidst all the tariff rates that we're seeing at this point in time.
From an investor's point of view, it is getting a little bit confusing here because you're seeing such influence coming from outside the Federal Reserve, something we've probably never seen to that extent since the 1970s when President Nixon was around. So that's disconcerting because you're not sure who you're supposed to be listening to. Are you supposed to be listening to Jerome Powell or some of the voices who are contending for his job, which seems to be the case. And of course, at one point there was a threat that they may even bring in somebody or they may nominate somebody earlier, and then you would almost have a shadow Fed in place. This is not an ideal scenario, and apart from anything else, it undermines the US dollar. This is not the way to really support your currency. So that has to be taken into account. at the same time, people will be happy that there's not too much volatility in currency markets. There's things going on, but it's not too dramatic yet. That would really be a concern. If we start to see where the dollar falls precipitously, then things will start to get a bit dangerous. For now, it's gradual and contained. And for the moment, investors can live with it.
Contained, Fabiana?
For now, it is. But again, we don't know what's going to happen next. So, in our portfolios, we try to stay as diversified as we can in terms of asset classes and also in terms of currencies, because frankly, you don't know what else is going to happen.
Do you know how many cuts he's going to make? Because, some say no cuts this year, but we had Lombard saying 3 for the year.
Well, actually, I don't think that even the Fed knows how many cuts it's going to make for the end of the year, because they're trying to figure out if actually we're going to have a pass-through in the CPI numbers. So I would say, or the PPI numbers, so I would say that 2 cuts seem logic at this point in time. But again, time will tell.
Your take, Mark?
It's unusual for the Fed not to go with what the market is giving them. And at the moment, the market is pretty much pricing September as a done deal for an interest rate cut. You don't usually get big pushback from the Federal Reserve against us. So as we get closer to that date, if it's still the market pushing for that, Federal Reserve will probably give them the cut. But there's plenty of time to go before then. Things could change. But that's been priced in for quite a while, and people will be comfortable with it. And if you look at the overall conditions, they can easily argue that inflation is in the right range for them to be able to do so. So people won't argue with that.
Fabiana, just before we let you go, what's the one asset we should hold in 2025 for the best returns?
European equities.
And what kind of returns are you anticipating?
That is too difficult to tell. But the important, if you want, discriminant here is don't buy the whole market. Don't buy only defense stocks. I mean, look a little bit under the hood, because there's a lot that is changing in Europe. Hopefully, there's going to be also deregulation and a lot more spending on the fiscal side.
Great having you with us, Fabiana Fedeli of F&G Investments, and of course our very own Bloomberg M Life strategist, Mark Cranfield, in the studio. Well, we're counting down to the India Open. It is 3 minutes to kickoff time. Let's take a look at where they are at this point in time. Of course, a lot to take in terms of the tariffs that we saw from Trump. Sensex pointing to a lower open, just a tad down, about 0.1%. The Indian rupee, 85.72, is what we're looking at right now. Now, Indian officials say they've made their best offer to the U.S. and the fate of any agreement now lies in Trump's hands. For the latest on how negotiations are going, Bloomberg South Asia economy editor Ruchi Bhatia joins us now. Ruchi, take us through, what do we know?
Hi, Haslinda. In fact, some of us were awake all night trying to see whether India has finally sealed a deal with the U.S. or not. Having said that, even as U.S. President Donald Trump shipped out letters, he did say that the U.S. is very close to signing a deal with India. However, remember, the Indian officials have said that they've put their best deal forward. It is, of course, up to the White House now to take the deal ahead. But one thing is very clear, that India has made it very clear that there are some red lines. Remember, the farm community, the farm sector is an important constituency for Prime Minister Narendra Modi, and the government will not do anything that will upset the farm sector. So GM crops is going to be a big no, and not just that sector, such as dairy. In fact, India has said in the other FTA negotiations as well that they will not look to touch the dairy sector, the farm sector, in a big way, even as the US is pushing for greater market access in this area. So we really have to see which way the negotiations really go in the next couple of days. Donald Trump clearly saying that July 9th deadline is going to be pushed ahead, and especially for countries where the negotiations are still underway. So let's see how the discussions really go ahead in the next few days. But one thing is very clear, that it's very close, yet so far the Indian government has not been able to sign a deal yet, and there are these red lines that they do not plan to cross.
From the signs so far, what are the chances of a full trade deal?
So a full trade deal, Haslinda, is going to be still some time away. Remember, the deadline for the full trade deal was only in the fall of this year. So far, what we do know is that it is quite likely that there could be an interim deal if the red lines are not crossed, if the US, for example, budges on the sectoral tariffs as well as the baseline tariffs. Now, those are some of the demands from the Indian side, but we still don't know how the discussions will pan out in the next couple of hours, in the next couple of days, because it will now really boil down to where the leaders really take it, where Prime Minister Narendra Modi as well as Donald Trump really take it. As I said, very close yet so far. Let's see how the discussions pan out. But a full deal is not happening at the moment. We will see only a few sectors that may be touched, which could include, for example, the likes of industrial goods, some part of the auto sector as well. But a full deal is going to be still some time away.
Ruchi, how does a win-win deal look like for India?
A win-win deal for India would include, for example, getting rid of the sectoral tariffs, getting rid of the baseline tariffs, or even if India, for example, were to get tariffs, then there should be some sort of a big tariff differential between countries like India and Asian rivals like China. That is, of course, from the Indian side. From the US side, of course, they want more access and greater market access to the Indian market. The strength of the Indian market is something that is very well known across the world, and they are looking for an unprecedented access there. But whether the Indian government will be able to give that kind of access is something that we will have to wait and watch out for.
Ruchi, thank you so much for that. Bloomberg South Asia economy editor Ruchi Bhatia there. Still to come on the show, the Reserve Bank of Australia is set to announce its latest rate decision, with most economists expecting a back-to-back cut. We'll have a preview next. Keep it here with us. This is Bloomberg. We're keeping an eye on Australian assets ahead of the RBA decision in the next hour. The central bank is expected to deliver its first back-to-back interest rate cut in 6 years. For more, let's bring in our economy reporter Swati Pandey in Sydney. Well, it's tipped to cut for a third time this year, Swati.
Yes, so the RBA's easing cycle is gaining momentum. Markets are fully pricing in a rate cut, and a majority of economists in the Bloomberg survey are also predicting a cut. There is a small chance, though, that they could surprise with a pause, because we have not heard from the RBA in the past 7 weeks since they last met in May. So they could surprise, but in May they did say that they wanted to be a source of certainty and predictability in this uncertain environment. So if that logic still applies, then it's a cut today.
Well, they have to keep an eye on inflation. We know that retail sales, though, have been pretty weak, even with inflation falling. Not everybody agrees or is confident that a rate cut will help.
Yes, and that is largely because Australia's productivity growth is really low. It's amongst the lowest in the developed world. And that is prompting some economists to say that the recent cool down in inflation that we have seen may not be sustainable. The government spending is also pretty strong. People have received tax cuts last year. They have also received some rental assistance, electricity subsidies, and that is making people confident about their income. Latest data on wages was also strong. So there are definitely some question marks around whether the slowdown in household spending that we have seen the first half of this year will continue in the second half. Housing prices are also on a tear once again. They are hitting record highs in a number of cities around Australia, and that does give people more confidence about their assets and wealth position as well.
Swati, what's the outlook for the Australian economy, especially amid those tariff talks that are happening right now?
So Australia got off relatively lightly with the baseline tariff of 10% from US. And we have not heard from Donald Trump in the past couple of days whether that stays or not. But Australian Prime Minister Anthony Albanese was trying to get a better deal. Even if we don't get a better deal, 10% is not bad. There was a modeling done by Productivity Commission which showed that Australia will actually modestly benefit, although the uncertainty and business-related uncertainty, investment-related uncertainty will probably weigh, and Australia's dependence on China will probably weigh on our outlook as well. But for now, it looks like the situation is not as bad as it is for some other countries.
And what is deemed as the biggest risk for the economy?
The biggest risk for the economy is tariff and tariff-related uncertainty because of Australia's dependence on China, which is our #1 trading partner. We export our iron ore, milk, agricultural produce to China. If China suffers heavily, if there is a huge slowdown, big slowdown in Chinese demand, that is going to affect Australia's economy. In the past, Australia has been able to find other markets, but with the protectionist policies that we are seeing around the world, it does make Australia's small export-reliant economy at risk.
Swati, thank you for that. Our economy reporter, Swati Pandey in Sydney. And of course, subscribers can also turn to the terminal for the upcoming RBA decision. T-Live Go is your function for the latest updates, plus commentary and analysis from our expert editors. And here's some other stories we are following. Bloomberg has learned that Apple's top executive in charge of AI models is leaving the company for Meta. Sources say Roming Pang is joining Meta's new super intelligence team after being offered a package worth tens of millions of dollars per year. Pang joined Apple from Alphabet in 2021 and had been running a roughly 100-person team responsible for the company's large language models. And Capgemini has agreed to buy IT outsourcing firm WNS in a $3.3 billion cash deal to boost its AI exposure. Capgemini shares fell in Paris on concerns AI tools will undermine the consulting firm's existing services. It expects the deal will close by the end of the year and deliver a 4% boost to its 2026 earnings per share. And before we go, here's a look at our show tomorrow. We'll be live from Hanoi at the Techcombank Investment Summit for an exclusive interview with CEO Jens Lottner, plus Vina Capital Deputy CEO Tu Nguyen will be joining us, along with the U.S. ASEAN Business Council President and CEO Ted Osius. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.